In this video, I'm going to share an investing secret that clients pay me thousands to learn. And guess what? You're going to learn this absolutely for free. Stick around, because by the end of this video, you will learn something so powerful that it will save you from years of losing money and costly investing mistakes. Trust me, you don't want to miss this one. So let's dive into it. So first of all, let's talk about the problem with DCA, or dollar cost averaging. And this is something that's spread across the last couple of years, like a nasty virus. And there are a couple of issues with it. And the idea is that with each dip, you slowly average into the market in an attempt to get an average price over time for your investment. But the main problem is, how do you know actually when the dip is? Because it could just keep dipping and dipping and dipping, and surely you can run out of money. And eventually, if you keep buying the dip, you actually end up being the dip yourself. And so you have to ask yourself, are you actually buying with a structured method for scaling into an investment? Also, another problem with common advice about dollar cost averaging is that there is a lack of awareness of knowing when to sell. Because a lot of people, they just hold an investment for years, but never actually trim any profit whatsoever. And you have to ask yourself, are you living to invest, or are you investing to live? Because these are two very different things. So many years ago, in September 2020, around the time of lockdown, I had a friend who bought Tesla stock at $110, and the price of Tesla stock started increasing very rapidly. He got so excited and he wouldn't stop talking about it, and it kept increasing and increasing. And he made future plans to go on holiday, move to a new location, and eventually the stock soared to $200, $300. But throughout this whole process, he never took profit whatsoever. And then 3 years later, in January 2023, there was a major market crash, and the price of Tesla stock went from $400 back down to $110, which was exactly at his entry price. A key takeaway from this is to separate unrealized gain from realized gain, because unrealized gain is just a vanity metric. I teach clients all around the world in trading and investing mastery, and this is a common mistake they do before actually coming to me for help. Because until you physically press sell, you've not actually made profit. A lot of social media will tell you to just blindly dollar cost average and to never take profit and just to hold the investment for the long run. Someone could be at level 10 in their investing journey, and they have substantially fewer resources than someone at level 90. But the reality is, those people should really use two different approaches because they have different levels of capital to work with. For example, someone who has $1,000 to invest should really use a different approach to a business owner who's making, say, $100,000, $200,000, or $300,000 a month. The person making $1,000 is in growth phase, but the person who makes, say, $200,000, $300,000 a month is just trying to preserve their wealth. But regardless, someone at level 10 and someone at level 90 should really try to be as efficient as possible with their capital, rather than just dumping all their money into the markets. And so it's important to work smart, not hard. So this leads me on to the second point, which is wealth equals price appreciation plus unit accumulation. See, most amateur retail investors focus on price appreciation. So they buy an investment and wait for it to go as high as possible. But what they fail to realize is that price moves up in waves. So breathe in, breathe out. Price doesn't just go up in a straight line. And it's actually in these pullbacks where most of the money is made, contrary to misconception. The second part of the equation that most amateur retail investors leave out is unit accumulation. And by this, what I mean is a focus more towards active investing. So when the market goes up, you trim off 10, 20, or 30% of your investment or stock. So you have cash reserves to buy back more units of the stock upon pullbacks. So let's say, for example, person A buys 10 shares valued at $100. So they have $1,000 invested into the market. And let's say the price of the share goes from $100 to $1,000. Now that person has $10,000 in the markets because they have 10 shares valued at $1,000 each. But let's say person B, who's a bit more savvy and also buys 10 shares at $100. And so again, he has $1,000 invested into the market. But as the market goes up, he trims off 10, 20, or 30%. And upon pullbacks, he uses the profits to accumulate as much of the stock as possible. Now, if that person keeps doing that for a couple of months, whereby there's a huge run up in the market, he trims off some profit, waits for the pullback, and uses the profits to accumulate as much of the stock as possible. That person will not only benefit from price appreciation, but also from stacking as many units of the stock as possible. So by the time the stock value goes to $1,000, that person might have 20, 30, or maybe 40 stocks instead of 10 stocks. So person A only benefited from price appreciation. Person B benefited from price appreciation and unit accumulation. I believe in principles, not tips and tricks. And this principle applies to any investment. A common mistake that clients make before coming to me for help to be a profitable trader or investor is that they buy a certain investment, whether it's a stock or a cryptocurrency, with an expectation of getting 900% or 1,000% return investment. But during the run-ups, they don't take off any profit whatsoever at key levels. And again, most of the profit isn't actually made by buying a stock or investment and waiting for the end target. It's actually made upon the pullbacks by scaling in and scaling out of positions and actually getting as many units of the stock or investment as possible. One key realization is that the market doesn't care about you. Expectations are the enemy of the market. Professional money management firms don't just focus on one set profit target to sell off all their investments. They actually scale in and scale out of investments. Whereas amateur retail investors often keep buying the dip for an investment, but once the price actually reverses and goes up, they just wait for one rigid target to sell off all their investment. As a professional trader who's been in the markets now for over a decade and has lived through various bear market crashes, often I find that people who try to time the top or the bottom often tend to be the first people who sell off all their position as soon as there's a reversal or a brief rally up. But once they sell off all their position and the market continues further up, they tend to be the first people to FOMO back in, and it just leads to chaos. I think a key mindset shift is that trading and investing is a game of probabilities, not certainties. I often find that people have a very blasé attitude when it comes to trading and investing, as it's some sort of hobby. They come back from work and they say, oh, I'll just pop the kettle on, and whilst I'm at it, I'll also on Netflix. Oh, and on top of that, I'll just open my trading charts, and why don't I just open a trade? So it's very casual, but you have to realize that trading and investing should be treated like a business and not a hobby, because you're competing with some of the brightest minds in the space. The best traders and investors actually make more than celebrities and movie stars and actresses because they manage billions for hedge funds. A common recurring mistake that I see amongst retail investors is that they make investment decisions based on very subjective methods. Perhaps they have a quick look at news or a quick glance at Market Watch or Yahoo Finance, really second guesses based on speculation. However, professionals have rinse and repeat systems to come up profitable across the long run and use statistics as well. And if you're sick of losing money as a trader or an investor and want to be profitable and be part of literally the best trading and investing community in the space, then join us at MDX Algo. You'll also get access to our daily professional coaching sessions. In fact, I do 3 of them a week. And if you sign up using my link in the description below, you'll also get 10% off every month. It's not enough just to blindly dollar cost average into an investment and hope for the best. And maybe at one point in time, you will sell off all your investments at a magical price. It's important to have an actual professional back-tested method that actually stands the test of time. Hopefully, the lessons in this video will help you to avoid losing money and making years of costly investing mistakes. If you enjoyed this video, then you will love my previous video in which I cover 10 years of investing secrets learned from actually being in the trenches. Also, don't forget to like, subscribe, and hit the notification bell if you haven't already to not miss out on my weekly videos.